Good day, everybody, and welcome to the Ben and Boz narrated PowerPoint series. I'm Boz.
I'm Ben.
How you doing today, man?
It is a great day. How are you?
You know, I'm excited because lessons 1 through 4 were the overview of financial accounting.
That's pretty cool stuff.
Yeah, but that was kind of like the framework, right? And now, for these remaining lessons, we're going to just start digging into the details.
I thought the overview was great. The details are going to be even better.
Yeah, but you know, we've introduced sales to folks. We've introduced accounts receivable, but there's more there than what we've showed them so far. There is.
I can't wait to tell them about it.
Well, I tell you what, you're the leader today, so
Woo-hoo. I want to start with an example.
Do it, man.
Because I'm the leader.
You are. Go ahead and do it.
All right, let's do it. So, first one, we're going to be looking at CVS Health, pharmacy, also some retail side of things.
There's millions of them around.
I don't know about millions. But
CVS and Walgreens. You can't find a street corner without them.
They have had some big acquisitions lately with Target Pharmacy and things. But here we have an excerpt of their income statement. And Boz, what jumps out at you about this one?
That they have $185 billion worth of sales. I mean,
that's nothing to bat an eye at. Huh?
I told you they have millions of these things out there.
So you were looking at the revenue side.
I was.
Hey, that's the topic of today.
I always go straight to revenue.
But you know what? We got a bonus here too.
What is it?
Net revenue. Did you see that? You see that? Yeah. So what does that mean?
I think we're going to find out.
We are going to find out.
It's kind of implying that there's a gross and then there's maybe an adjustment before we get down to net revenue.
It's like just looks weird or something?
No, gross means undiscounted when we're talking about it in finance terms.
Kind of like a total. There might be some things that reduce it. We call it net revenues. Cool. So we're going to be looking at that. And then the other side of revenue, we have accounts receivable. So,
net.
Oh, sorry.
Oh, sorry. I jumped the gun on you.
That's okay. What I was going to point out is that we have net revenues of $185 billion and receivables are 13.1. So
why does CVS even have? You picked this example. This is a bad example.
This is an outstanding
example. Why does CVS even have receivables? I go there and I just pay in cash.
Well, we got to look at revenues for CVS and think about what are their revenue streams.
They sell stuff to me,
like frozen pizzas, for example.
For cash. Yeah, sometimes I buy $100 worth of frozen pizzas
at
a time there.
Frozen pizza.
Yeah, but I pay cash.
You return it?
Anyway, probably not, but anyway.
So that'd be one side of their business. The other side of their business, do you ever get any prescriptions at CVS?
Yeah, and I pay cash for them.
You pay cash.
So I don't know,
But do you ever get a statement from your insurance company saying how much those cost? So all those insurance companies then reimburse CVS.
So they have receivables from insurance companies. So gotcha.
It's actually kind of a complicated revenue stream, but we're not going to get into it a ton.
That's
but
true. Okay.
What we will get into, looking at accounts receivable, this is an excerpt from their 10K here down below, where they had a beginning balance of $286. This is the allowance. So a receivable is being reduced by $307. That's the net piece.
Okay.
And so they had a beginning balance of $286. They added some to it, subtracted something called bad debt expense and write-offs, which we're going to talk about today, actually.
This is the first time we've introduced them. So that down there is just kind of an allowance for doubtful accounts, kind of like an allowance for bad debts. Doesn't mean a whole lot to folks right now, but that $307 million is what they are kind of estimating. That's the portion of their receivables they might not collect.
Yeah, if you think 307 out of 13,000, well, that's not that big. But let's actually think about dollars. $307 million they're thinking they won't collect.
The people aren't going to collect. Well, we better teach them more about that too.
Yeah, we should. Probably worth their effort to try and collect it.
Totally.
All right, so a little bit of the overview. A couple of main goals here. We're going to learn about sales at a whole new level of depth. Specifically, learn about how do companies deal with credit cards, returns and allowances, and discounts. And then number 2, we're going to learn about accounts receivable at a new level of depth. We're off on our timing. Let's stick to numbers. We'll get it back. 2 new accounts that we're going to be using, bad debt expense and something called the allowance for doubtful accounts. And then we're also going to learn how do we estimate that allowance using percentage of credit sales and AR aging method. So don't worry if it doesn't make a ton of sense right now. Just kind of big picture, sales, accounts receivable, looking at new depth on there.
Stick with us.
All right. So first question was sales. Well, when do we actually record a sale?
I don't know. When we sell stuff.
Yes.
Right?
Recorded when goods are delivered or services are provided. Bringing in a couple technical terms early here. First one, for goods in transit, FOB shipping. And Boz, what does that mean? And what's the opposite of that?
FOB, free on board, right? So free on board shipping. Yep. Free on board shipping or shipping point is sometimes referred to as. So basically that means that the ownership of the goods is going to change when it leaves the seller's dock. So when it leaves the seller's warehouse, that's when the buyer is going to take responsibility for those goods.
So like if CVS, if they were buying drugs from the manufacturer, as soon as those goods left the manufacturer, they would be CVS's. Even though CVS doesn't have it in the store, the ownership has transferred if it's FOB shipping.
Yeah, which is different than FOB destination. We did that one well. But yeah, an FOB destination, that is going to be when the goods actually reach their destination. So it's simple. When I go buy something at CVS, I mean, it leaves them and it comes into my hand immediately, right? So I mean, the shipping point destination happens simultaneously. But to your example, if a supplier is selling something to CVS, those goods might be in a truck for a day or two, as an example. And if it's FOB shipping point, the revenue is recorded the moment that they leave that supplier's dock. If it's FOB destination, the revenue is not going to be recorded until it reaches actually CVS's possession at that point in time.
Exactly. And so when we're talking about recognizing revenue, we're saying with the manufacturer, CVS won't recognize any revenue until they actually sell it, and they probably won't have much of a timing issue with just their businesses that they're in.
Sure.
So the question is, who really cares about the difference? Like, Boz, are we just talking about a day or two here with a truck delivering or driving across the country?
Usually, right?
Yeah.
So usually it either happens at the time, like when we're buying from CVS, or it's just a truck shipment, right? And that's probably not going to be more than a day or two. But especially with all the manufacturing that happens in China, as an example, I mean, they're not putting the heavy equipment on a plane or something like that and shipping it that way. They're putting it on a boat that can actually take a matter of weeks. So you can consider, what if a manufacturer gets done with some goods on December 20th, puts them on a boat, and it's going to take 3 weeks in order to get it to their customer, right? So that means that those goods will be just somewhere in the Pacific or Atlantic Ocean, basically at the end of the year. And
whose goods are they?
Well, yeah, and you can go right back to if it's FOB shipping point, then they're the customer's goods, and if it's FOB destination, then it's the seller's goods at that point in time. So
yes, and this brings up the liability idea. So what if there's a big storm in the ocean? Those are huge boats, and one of them tips. It's happened before in the past.
Yeah, who's got to pay for the insurance? So
exactly, and usually there is insurance that you're going to get when you're transporting those goods, just in case whoever's transporting it somehow crashes or loses them for you, you'll get it covered. So, although with CVS, interesting with prescription drugs, sometimes insurers will not cover that. Because it'd be auto insurance in a truck, but it is so expensive for that truck with all the prescription drugs. You're talking $1,000 a pill sometimes. That the auto insurer will refuse to cover that shipment. It's too expensive for them.
Wow.
The risk.
Okay.
Yeah.
They need good drivers then.
That was an actual scenario from a trucking company. They didn't want to do any more of those because they had a truck that crashed once. Anyway, we're drifting a little bit. So revenue recognition is a lot more complicated than we're talking about here, but that's more of a topic for intermediate accounting. There's just been some new revenue recognition standards, and a lot of professionals are working with companies to help them figure out what to do over complicated contracts.
So when we say revenues recognized, when goods are delivered, services are provided, that's basic. It goes a lot deeper.
Exactly. All right, so let's jump into our first type of discount, looking at credit cards. And the first question is, why would a company even accept a credit card in the first place? Well, the big one is, Boz, do you carry a lot of cash with you?
Sometimes. So sometimes. When you say a lot, I don't know how much you expect. So sometimes I got $100 on me, right?
Let me try and bring it down to maybe our audience is a little bit younger generation. And some of us in the younger generations don't carry any cash at all. It's all credit cards. So if a business doesn't accept a credit card, I can't pay them for anything. I'm not going to use it.
Not going to make that sale then.
Yeah, exactly. So bring in new customers because they accept that form of payment. And the good thing is that they receive cash right away. If they receive a credit card, they just tell the credit card company, "Hey, this Boz had a cost or a transaction of $100," and they send it in. And they get their cash that night or the next day usually. So they don't have to have credit risk waiting in case Boz doesn't pay me.
So it's as an example. So I've sold books before. As an example, I wrote a book, and if someone wants to make a credit card payment, they just give that to me within a day or two. I'm able to transfer that from my PayPal account, as an example, into my bank account. And then it's up to the credit card company to collect from that customer. And the customer might not pay them, right? There could be issues there, but if the customer doesn't pay the credit card company, that does not impact me at all.
So credit card
then the bank is on the hook for it and everything.
So the only downside here is that businesses are going to have to pay a fee to the credit card company for this service.
Yep, totally.
All right. So the big question is, why would a business even want to do this? What's in it? So the big question is then,
You're too quick on that. I won't be able to edit that.
how about now? Hey, boss, edit it here.
Give it a 2 second. You don't have to.
Okay. So the big question is then, what do the credit cards gain from this type of setup? And the answer to that one is that businesses pay a fee for accepting the credit cards. And typically it's around 3% or so, but they have to record that. And that's going to be our first reduction to sales revenue and give us net sales revenue.
Exactly. If I sell a book for $15, I don't get $15. I get something. The credit card company takes their cut first. So
it's disappointing, isn't it?
It is. So, but at the same time, it helps me make that sale, which I otherwise might not be able to make.
Yeah, exactly. So let's see, what does this look like from the company's standpoint? If a customer is going to pay with a credit card, the journal entry here, start with a debit to cash. And even though it's technically a receivable, most companies will just do cash because they're going to get the cash the next day anyway. Then they're going to debit something called credit card discounts. This is a contra revenue account. I don't think we've had one of these yet, have we, boss?
Nope, not a contra revenue.
All right, so it's going to have a debit balance, and sales we know has a credit balance. So it'll reduce the sales to give us net sales, and that's going to be then a credit to sales.
Yeah, so just to illustrate that, like if I sell a book and if I generate that sale through PayPal, to illustrate Ben's point, I would just debit cash right away, even though technically for about a day I can't get that money from PayPal. So maybe technically for a day I have a receivable from PayPal, but I can transfer it almost immediately. So that's why we just debit cash straight up.
So when you're bringing in $1 billion a day around year end, that might be a big deal.
Yeah, that could be actually when I'm bringing in $1 billion a day. So we'll wait for that moment.
Well, let's move on and do a little bit more depth example here. So we have James. James is going to be our focal person today. He's purchasing $100 worth of supplies from CVS using his credit card, just general supplies for whatever he wants. And the card is going to charge CVS a 3% fee for each transaction. Usually it's around 3%. American Express a little bit higher, but that's negotiated between CVS and the credit card company. And the supplies cost CVS $50. So at the very initial journal entry, what we're going to do here is debit cash. We're CVS in this case. Debit cash for $97. Debit credit card discounts for $3, and we got that one by taking the $100 worth of supplies times the 3% fee. So we have. Thank you. I appreciate that. And then we're going to go ahead and credit sales for $100. There's more difficult math ones coming up. I'll let you handle that. And then, of course, we can't forget about cost of goods sold and inventory as well, the other half of any sort of journal entry when we're going to sell goods. All right, so that's it. There's no additional entry, anything like that. What we would show on our financial statements is net sales. And that's the idea of sales of $100. You see we recorded that right here. Less the discount of 3 gives us net sales. And most companies aren't actually going to disclose the dollar amount of the discounts just because it's kind of their own competitive advantage. Probably credit card companies won't like it, but they just say net sales is all they're going to show, the $97.
Yeah, they certainly have their financial systems that compute everything in the background and everything, but on the financials, oftentimes just net sales.
Yeah, and they're going to want to track this discount and all the other types of discounts that they give to help them with some better analysis. Ready to move on?
I am.
All right, let's talk about returns and allowances.
Companies don't like these. This is sad.
It is
People
sad.
buy something from you and then they return it. They don't like it. They bought too much, something, right?
Something. There could be a few different ones,
Yeah.
but basically, customers just don't need it for whatever reason. And it is more common in certain industries. You added retail in here because customers, think about right after Christmas, for example, people take things back all the time. Hardware and auto parts. I thought this was fascinating when I learned it. People would go to hardware stores and auto parts stores and buy like 4 or 5 different parts if they're not sure about the size.
Sure.
And auto parts store, they know about it. They're fine with it just because they get that one sale, but then they'll return the other ones.
It's kind of like me when I go buy 5 shirts and then I bring them home and I ask my wife, which 2 that I should keep because I can't make these decisions for myself.
It's a rough life, boss.
That's right.
It's totally a rough life.
Return the other 3.
All right. So when we have this returns and allowance, the selling company, what type of journal entries are they going to have? Do you want to take us through or you want me to?
I can do this one. I can see.
I was on a roll, but that's fine. I'll share. That's okay.
You'll share.
Yeah, that's okay.
I like it. So
all right.
Yeah.
So
when the goods are returned, so we need to. We're not going to debit sales when goods are returned. That's what you might think, but we actually debit a special account called Sales, Returns, and Allowances. allowance is, and it's so companies can track this separately. They want to know what they have for returns and
I was
allowances.
going to ask you why, but you're on top of your game.
Well, yeah, I mean, I think it's just one of those, a company wants to track returns year over year, right? And if returns are really starting to go higher, that might be a cause for concern for the company.
And you could track returns too by specific product as well.
Exactly.
And get an idea.
Mm-hmm. Yeah, and then credits to account receivable or cash, just basically however you sold it to someone up front.
Yeah,
you're going to give that back.
Yeah, they're not going to pay you anymore. So, and then
yeah, but now you've got the inventory back, so now you debit the inventory. When you sold it, you credited it. So now you're just unwinding that transaction. When you sold it, you debited COGS, credited inventory, unwinding it, debiting inventory, crediting COGS.
So that's interesting. The sales side, we don't just go backwards and unwind it at all, but the inventory side we do.
Yeah, that's true.
And we can track it through that sales returns and allowances. That's the biggest reason for that. Mm-hmm. All right, so let's do a little bit more of an example. Here we're going to have two sets of entries, an initial purchase entry and a return entry. So we got James again purchasing $100 worth of supplies on account, and the supplies had a value to CVS of $50. That was their
I
cost.
think it's kind of boring to have them purchase supplies. I think it should have been $100 of frozen pizza.
If only someone would have put that in the original version of the slides and someone else didn't take it out, Boz.
That's true. Well, anyway.
Anyway, you didn't do that, did you?
No way.
Oh,
No
okay.
chance.
Okay. Well, we're going to go ahead and debit accounts receivable for $100. James is a frequent customer of CVS, and so he has a receivable account with them. And then CVS is going to go ahead and credit sales for $100. So debit accounts receivable, credit sales for $100. This should be a review at this point, right?
I hope so, yeah. We taught them this one back in lesson 3.
Yeah, and then we've got to remove the inventory. So we're going to debit cost of goods sold, credit inventory. Boom, we're good. Initial purchase entry.
But then something sad happens.
Yeah,
James doesn't need all the supplies. He brings them back.
Let's just say frozen pizza. He doesn't need $100 worth of frozen pizza. So, Boz, you want to take us through this example?
Yeah, that would be great. So just like on the previous slide, debit the sales returns for $70, credit the accounts receivable for $70, and then the math here actually is that it's 50% of the sales amount is what they paid for it. So half of that 70 is the 35. So that's the amount that we're putting back into inventory with a debit and cost of goods sold with a credit.
As long as we're talking about original having frozen pizza, I also had more difficult math for Boz here because I know he can handle it, but we changed it to make it a little bit easier. So when we have this type of situation, net sales, what we're going to show is a credit to sales for $100 minus the returns and allowances of $70. So really net sales here is only $30.
True.
That's what would show up on our income statement, just that $30 amount for net sales. All right, one more example here on the sales side is with discounts. So what happens here is that a lot of times companies are going to provide discounts to entice customers to purchase more. And I'm not talking like just showing up at the store, 50% off, here's the coupon. Although that would have its own separate type of account. We're talking here more business to business type transactions where we're going to have a customer that does a lot of business with someone and say, okay, if you keep doing more, like a bulk discount, we'll give you a discount for that.
Yeah, well, what we're really getting into here is not a reduction in the sales price, but it's a reduction in the amount that you have to pay as a customer if you make payment more quickly.
Exactly. So it's another way of incentivizing customers to pay more quickly. And so one typical one that we see here is 210 net 30. That's how you would read this, 210 net 30. And what that means...
Is that English? What even is that?
That is English.
Okay.
210 nets auf 30. That's be German.
That's great. So what
with
does
a couple made up words
in
there.
What does 210 and 30 mean?
All right, so 210 means a 2% discount is provided if the customer pays within 10 days. Otherwise, you have to pay the full amount within 30. So you see, you get that. Do you think companies are, if say, a company gets this, do you think they're going to take advantage of the discount?
I think absolutely. If you can save 2% by making payment 20 days earlier, I mean, we could annualize that. That's like a 26%. I'll just round it off annual interest rate. That's huge. It's actually larger than that. I did the math wrong. But anyway.
Is it like 28%?
It's like 36%. Yeah.
Is it?
But yeah.
It's pretty good.
Yeah, it's high. It's a high interest
It's
rate.
high. So basically the gist of it, take the discount when you can.
Absolutely.
All right, so what happens from the company's standpoint, the company that is offering the discount here, when the customer takes advantage, you're going to debit sales discounts. Again, special account so you can track it. Make sure you know who is taking advantage of that. Debit cash because the customer is going to be paying for it. And then you're going to credit sales.
This one's a little tougher, so we'll definitely jump right to an example here.
Yeah,
to look
absolutely.
At this one.
So initial purchase entry, we got James again, purchasing $100 worth of supplies.
We've been there.
And he gets terms, 2 or 10, net 30. So the initial purchase entry, you said we've been there. Guess what? Nothing changes. It's the exact same. What's a little bit different is now that James is deciding to take advantage of this and pay on day 9. A lot of companies will pay on day 10. Some will probably pay on day 13 and still try and take the discount, actually.
And they won't get it.
They shouldn't get
unless
it.
they
but
can sweet talk.
yeah, exactly. So what's going to be the journal entry at that point? Well, James is going to pay cash in 98. So CVS is going to debit cash for 98. They're going to debit the discount for $2. And the thing is here, they have to credit the entire accounts receivable amount of $100 because James isn't paying any more at this point. Even though they only gave 98, we have to get rid of the whole receivable.
The most common wrong way to think about this is someone would just debit cash for 98 and credit accounts receivable for 98. But if you did that, you'd be left with a $2 balance in the accounts receivable, and James doesn't owe you any more money, so that would be a problem. So that's a little tricky, but that's
something
why you got
to watch out for. Hopefully you're good at it now.
That's right.
And then so next part, how would this actually show up on an income statement? Well, we'd have sales of $100 minus our discounts for $2, and that gives us net sales of 98. That is the number that you would see on the income statement then.
So a lot of different ways we can get from gross sales down to net sales.
Yep, and a lot of different types of discounts
Yeah,
too.
absolutely. Credit card fees, returns, sales discounts, a lot of stuff.
Man, sales
I think we've covered it.
Sales is fun, but I'm ready to move on to accounts receivable,
And
the
bad debt
allowance
expense.
for doubtful accounts. All right, so Boz, do all customers always pay their debts?
No.
I thought it was unfortunately no.
Unfortunately, no.
Unfortunately,
So, that's
no.
right.
It's just a fact of life. If you're doing whatever it was, $13 billion in receivables, and I guess I don't know how much of their revenue is that, there's going to be someone who's not going to be able to pay you. Just financial difficulties, things happen, you know you're not going to get all your money.
Yeah, usually people plan to pay you when they purchase from you. There's very few people that don't plan to do that. That'd be completely unethical.
And you're not going to
but-
make a sale to someone unless you expect to get paid
Yeah,
on the way
so-
back. So
But a lot of people, buy stuff. They plan to be able to then resell it and make some money. But all of a sudden, things happen on their end. They can't resell the product, and now they can't pay back their supplier.
would you call this a fact of life?
It is a fact of
It
life.
is a fact of
definitely.
life. All right. So, couple different methods. Boz here likes to explain this older method that nobody really uses. So go ahead, Boz.
I don't like to explain it. What it is there's a method called the direct method.
Oh, sorry. Is that a little harsh?
That's fine if it amuses you. Where a
It
company, it might make sense if someone can't pay you that you would just debit a bad debt expense and credit an account receivable. All right. And that's where we're going to get to at the end of the day in the indirect method. But this might seem logical, but the problem with it is that this write-off, oftentimes, you won't know that a customer is going to not pay you until maybe the year after you make the sale to them. So in that situation, you record the revenue in year 1, the expense in year 2, and it is not properly matched.
You're going to make me look bad in year 2. Extra
Yeah,
expense
definitely.
that should have really reduced income in year 1. So.
Yep, definitely. So that's why we are going to go to not using this one, and we're going to use the indirect method instead.
All right, and the indirect method is much more common. Some small businesses might use the direct method, or if they don't have a lot of experience. But indirect method is what a lot of your large companies are going to use, and that's where you reserve part of accounts receivable based on your estimate of not being able to collect some. And again, it's an estimate because you don't know who's not going to pay you. You just have to kind of make a guess at that time, and that's when you set up the allowance for doubtful accounts.
I mean, you don't know. I mean, if you did, you wouldn't sell to them, right?
Exactly.
But the point is, you're going to sell to a bunch of people knowing that a couple aren't going to pay you. But that doesn't mean you're not going to sell to nobody, right? That wouldn't make sense. So, but I mean, you try to do some checks. You do credit check and so forth. But
and so then in that year that you're going to make the estimate, you're going to debit the allowance for doubtful accounts. That's a contra asset account. And sorry, you're going to credit the allowance for doubtful accounts, debit the bad debt expense. We have a contra asset and expense account, so you're matching the expense in the year that you recorded the revenue.
a couple of new accounts we're introducing to them here.
Look at that. Isn't that cool?
Yeah.
You like that graphic?
That's awesome. You did a great job.
It's
man.
smart art. I didn't do it.
Smart art. So,
All right, so let's go through an example, make this a little bit more tangible for you. Company has $100 of accounts receivable, and they estimate that $10 is not going to be collected. So the journal entry that they make at that time is going to be a debit to bad debt expense and a credit to allowance for doubtful accounts. And so remember, they're not giving up on any one specific customer at this time. They're just estimating of that $100, we're not going to get 10 of it. We don't know who it's going to be. We're just going to say it's about 10. So match the expense to the revenue. We're good in that year. And then they have an allowance, which again is a contra asset account. All right. So then what does that look like for accounts receivable on our financial statements? Well, we'd have gross accounts receivable, kind of like gross sales we talked about at the beginning, minus our allowance for doubtful accounts, because again, it's a contra asset, so it'll reduce that asset value. And that gives us our net accounts receivable of $90. That's what we're actually going to see in the financial statements. So last thing then, when the company does find a customer and they're not going to pay us, they give up on collecting. They don't just do this easily. It's going to be a while, but they're going to give up on collecting the $10.
And the logical thing might be you'd say, oh yeah, you're going to debit bad debt expense and credit account receivable, right? That's what you're thinking. But
we already debited bad debt expense up here, so we don't want to have double the expense. It doesn't make anyone happy. We're going to reduce this allowance and say we set this aside thoughtfully. There's no money that's actually being set aside, but we thought of setting something aside. And so now we're going to use up that allowance. So debit the allowance and credit accounts receivable.
Yeah, and that's like a perfect world right there. Or the first entry we had $10, the last entry we had $10. That's not reality. We just we did that to make it easy for this PowerPoint.
Probably another fact of life is that it's never going to be exactly.
You can't estimate
equal.
perfectly.
Yes.
So.
All right. So the next question is then, we got $10 in that previous example that we're not going to collect. Well, how did we actually come up with that amount? And every business is going to have to go ahead and estimate that amount that won't be collected. And it's going to be very different for different types of businesses. And they just usually use historical experience, their knowledge of customers to come up with the best estimate. But in general, there's two main methods: percentage of credit sales and the aging of accounts receivable. Boz, do you have a preference on these two?
Percentage of credit sales is easier, so
it
but
is.
I mean, I suppose because of that, I actually like aging better, right? Just because it's more complex, a little bit more fun, a little bit more refined. So,
hey, it's better for accountants, right?
That's right. So I like aging better.
So anyway. Let's talk through percentage of credit sales as a first example here. Your goal with the percentage of credit sales method is to estimate the bad debt expense on the income statement. So when you're using this credit sales method, you're trying to get your income statement right for that period. You're going to guess what the bad debt expense is. And the way you're going to do that is take what are your credit sales for the given period, not total sales, but what are your credit sales, and multiply it by a given percentage. And I say given here because it's going to be given to you in your problems. If you're actually working for a company, you're going to look at historically what percentage of credit sales have we not collected on, and you're going to use that historical percentage adjusted based on the current situation. So just as an example here, let's say credit sales for the period were $1,000 and historically 2% were uncollectible. So Boz, you like this one. What's the amount and entry for bad debt expense?
Well, $1,000 times 2% is $20. So that's the amount of the sales we don't think we're going to collect.
I panicked. I'm glad you did the math.
That's good. So debit bad debt expense, credit the allowance for doubtful accounts, each of those for $20. So. And again, to kind of wrap this one up, this is more of an income statement approach to estimating bad debts, which is different than the balance sheet approach.
Oh, we should have said that in sync. I was wanted to link. See, $20 here is focusing on bad debt expense. On this balance sheet approach, aging of accounts receivable method, that's what we're going to focus on, right? Estimate the amount of accounts receivable. So what should we really show for net accounts receivable on our balance sheet? That is the key. That is our goal. So 4 steps. I think I should patent this process.
You could try.
Okay.
I have an IP lawyer who's a friend. I'll ask him.
Great. Step 1, you're going to take your total accounts receivable and break it apart based on the age of the receivable. So some will be current. They don't owe you yet. Some will be past due, 1 to 30 days. Some will be 31 to 60, so on and so forth until you get so old that you say, 61 plus, just over that. Step 2 then, you have all your receivable broken apart into buckets. So you're going to assign an uncollectible percentage to each. So very similar, we're using a percentage, but each bucket is going to have its own different percentage. And usually as the days get older, you have a higher percentage that you're not going to collect. Example here, in our current bucket, we could have a 1% uncollectible. 1 to 30, we could have 5%, all the way on up to our last one.
Company's just using its experience to come up with the uncollectible rates.
Exactly. And then step 3, what is the balance in each bucket? So we figured that out in step 1, multiply by a percentage in step 2, and then add it all together. That is our ending allowance for doubtful accounts. Now, I see a lot of mistakes with this where people take that and they use that ending allowance method in their journal entry.
As their journal entry, yep.
Which is why we have step 4, which is the idea of taking your beginning balance in the allowance, comparing it to what you want it to be in the ending, and then just making a journal entry for the difference between the two so your ending allowance is correct.
It'll become a little bit more clear when we go through the example.
All right. Woohoo! Let's do this example. We have accounts receivable of $1,000, and the first step is to break it apart.
Buckets.
Into buckets.
Yeah. So you got 5 buckets here. Current, up to a month past due, basically up to 2 months past due, up to 3 months past due, and over 3 months past due. Most of your receivables are going to be current. That's a good sign because
that is definitely what you want. Yes.
Yep, because it's good that people haven't owed you money for a long period of time. So you got it in the buckets.
There you go. So now we're into step 2, which is going to be assigning an uncollectible percentage to each bucket. Mm-hmm. This isn't really that cool of a slide because we're just giving you the percentages, mm-hmm. but if you were an accountant, you'd spend a lot of time figuring out in each bucket historically what percentage has been uncollectible in the past.
And as you note, the older that the receivable is, the less likely we are to collect it. And while is just an example that we made up, that's very real as well, that when the receivables get old, you don't have a good chance of collecting them. I think about it, back in college, someone bet me on a sports game, and I haven't got paid for it yet. I actually have forgotten who it was.
Is there
but
statute of limitations? Because I think sports betting is illegal.
Anyway, I didn't bet. That was just a joke. So,
that's great.
We were in Nevada at the time, right?
No legal liability here. So,
right.
Yeah, good answer. You're in Nevada. Step 3 now. We have our buckets and our percentages, so all we have to do is multiply each bucket by the percentage. So 700 times 1%, 100 times 8%, 10 times 20%. Boom, that's where we get this third line here, the uncollectible amount within each bucket.
Yep. So basically, after we do all that, $28.50 is the amount of our $1,000 receivable which we feel we are not going to collect. But we don't just debit bad debt expense and credit the allowance for that amount. We have to do one more thing. Step 4.
Step 4. Boom, adjusting the allowance for doubtful accounts. All right, so in this part, we just made up a number, arbitrary here. The ending balance is $20 right now in the allowance, and we want it to be $28.50. Mm-hmm. So, like we see, balance, $20. Good animation, Boz. He put this one in.
Thank you.
Desired ending balance is $28.50. So what's the difference between those two, math wizard?
$8.50, and that's what we need to do the debit to bad debt expense and the credit to the allowance for doubtful accounts.
You nailed it. You should be an accounting professor.
I'll think about that someday. I might apply. But
all right. This aging method does have a few more steps, but most companies are going to use this one.
Yeah, and just, putting it back to a point there of this $20, it's like, why was there an amount in this account? Well, I mean, companies that are years old, I mean, every single month they'll be estimating bad debts, doing a debit to bad debt expense, crediting the allowance for doubtful accounts. And then every single month they'll probably be writing off some bad debts too, which end up as a debit in that uncollectible account. So, I mean, they got all sorts of stuff going through that account. So this balance is, you're never going to know what it is, but where's the balance at? What do you want the balance to be? Make an adjustment for the difference.
Yeah, there'll be entire departments at companies that really just focus on collections and knowing each individual customer and the likelihood they're going to get paid. So it can get a little bit more specific even than what we're doing here. Yeah. And it does, actually.
And this is a rare account that the balance could be negative before the adjustment if you've actually had write-offs that have exceeded what you've estimated thus far. So this is a rare account that can actually be negative from time to time.
Cool. All right, so let's do some key takeaways and finish up here. First thing, companies are going to go ahead and track returns, discounts, different types of discounts using contra revenue accounts to better help them with their own analysis. And so you know how to set up those accounts, you know how to record things in those accounts. We're not just going to back out sales because we want to analyze everything to make sure we're not giving out too many discounts or who's taking advantage, things like that. And then takeaway number 2, we learned how to make an estimate each period to figure out or to get really a better number for our accounts receivable, looking at what should the allowance be, what should the bad debt expense be, matching those expenses to the revenues. And we talked about a couple of ways to make that estimate.
Exactly. So I think that's all we've got for today. So they're going to have to come back next time. Lesson 6, we're going to be getting into inventory and cost of goods sold.
Can't wait for that one.
It'll be a fun one, man.
I mean, sales is always fun, though, too.
It is. Got to sell stuff. There's no reason to do anything else. That's why we start with sales.
All right, everyone. Thank you for tuning in.
Cheers.